Hello and welcome. My name is Joe O'Mara. I'm the Head of Aviation Finance with KPMG. And on behalf of KPMG and Airline Economics, I'm delighted to be joined by Ted O'Byrne. Ted is the CEO of AviLease. He's joining us for the purpose of our Aviation Leaders Report 2025 and recording this in Singapore in early November as they count the votes during the US election. Ted, thanks as always for joining us. Before we may begin to the meat of the conversation, 2.5 years now, I think, into the AviLease journey. Do you want to tell us how it's going?
Great. It's been a bit of a journey. We've, as you said, we met 2.5 years ago, just after we were just launching. And in 2.5 years, I'm very pleased to report we've created a full-fledged platform. We have now a team of 80 people across 5 offices worldwide, headquarters in Riyadh. Here in Singapore, where we're speaking today, we have a small team which is developing actively. We have a team in Dublin, a team in Limerick, and a team in Fort Lauderdale. So we spent a lot of time developing the team, especially post the Standard Chartered acquisition. We've also spent a lot of time working on our processes and our systems, and really are investing for the future and to be able to scale up this platform. So it feels, after 2.5 years, like a real leasing company with capabilities to manage the portfolio of aircraft we've acquired and grow and scale. Right? So we're really thinking about the long term and trying to build a platform for the future right now. So that's the platform. In terms of assets, we have now 190 aircraft assets owned and managed, 167 owned, 23 managed on behalf of several investors. So it's starting to take shape. Our investment strategy on the asset side is really focused on next generation aircraft, but we also like existing 737 NGs and A320ceos. I think it's, especially right now with the constraints on the supply side, that makes a lot of sense. So if you look at our portfolio, it's about 3/4 next generation, 1/4 existing technologies. Really, in terms of credit, very high credit ratings. We have about 1.5 notches above the rest of the industry in terms of credit quality. We did this for 2 main reasons. One, because we wanted to start and make sure that our shareholder was happy with the risk we were underwriting. And 2, it sort of pays over the long term. We've seen this through COVID and other crises. We think having a sort of very high credit quality standing is important. Very clearly, the Standard Chartered acquisition was also the same policy and philosophy on the credit underwriting. So far, the asset credit mix is very strong, I would say. We're a little bit light on the wide body side. We only have 3% of our assets in wide bodies. That's going to change. If you think about what aircraft lessors do, we're sort of index tracking the fleet, right? And the fleet is about 25% wide bodies, 75% narrows. I think this is where we'll probably evolve over time. We'll see a lot of opportunities, particularly in the Middle East and in the KSA in Saudi Arabia, where there's a lot of wide body deliveries coming. So I think naturally we'll expose ourselves towards these aircraft there. But it'll take time. We have this is a journey. We have a bit of time. So on the asset side, we feel pretty good where we are. We can continue to grow, but nice little portfolio we built over 2.5 years. On the liability side, so we're sort of 1-to-1 leverage, so relatively low leverage. We have a pool of banks today that have given us unsecured, 100% unsecured financing, and 75% of our money is coming from non-KSA lenders. So it's an important fact. It was important to our shareholder that we would be able to show that we can attract capital into the kingdom, right? And mission accomplished, big check in the box there. We're borrowing at quite attractive rates, thanks to our shareholder. Our parent company is obviously a big influence there, and a lot of people want to do business with us already, so that feels good. So we're continuing to evolve our liability structure, but right now we've started, like the credit on the asset side, we started relatively low leverage to demonstrate to the shareholder that we can sort of ramp up our liability structure in a disciplined and organized way. And I think the next steps there for us is probably thinking about our rating. The company feels good from a process and systems and people standpoint. It's a platform that we think is rateable, both at the platform level but also at the asset level. Right? So that's probably something we'll look at for 2025 on a standalone basis. I insist on that. That's important, right? We want to make sure that we looked at as a standalone entity, not as a sort of a sovereign wealth owned entity, right? Not only as a sovereign wealth owned entity. And obviously on the shareholding side, we remain 100% owned by PIF. Big shout out to the shareholder and the board because they've, we started at zero. We're at now $7 billion in assets. In 2.5 years, that's big growth. So we pushed hard, and I have to say the shareholder has been extremely supportive. Very happy with what we've been able to deliver. I think they realize that we now have credibility in the market. We've built a profitable company. We're probably one of the fastest growing portfolio company at PIF today. And they've been extremely supportive in many ways, right? Not only shareholding capital, but also influence, transactional involvement. And the board has been very supportive in helping build the structure and the underwriting principle we follow. So it feels right. It feels very good, actually. We're in a good place. Going forward, I think we still want to become a top 10 leasing company, maybe higher, right? We're very clear that, scale equals value. And, we want to continue to scale to get to that, we think, 20 billion plus portfolio of assets on balance sheet, and then sort of a number of sidecar vehicles. So the first step is, continue to grow, maybe a little bit more moderated pace, following, the acquisition of Standard Chartered. We wanted to just slow down a little bit, make sure that we had the principles right. Now we're going to start reaccelerate, and depending on the opportunity in the market, we should deploy between $2 and $3 billion of capital of assets in the market on a yearly basis. Right, that's the growth rate I'm targeting. I've asked my shareholders to let me grow fast and let me grow slow. Right? Sometimes we have opportunities we want to accelerate and lean into and be aggressive on. Sometimes we need to just take a step back and say, let the market come to us. Right? And that's probably where we are right now. There's just lack of supply, so you don't want to rush into the market and underwrite any transaction. So A, continue to growth on the asset side. B, deliver a diversification that is rateable. Right? So we have a large portion of our portfolio in Saudi Arabia, 24% of our revenue is Saudi. We will do more transactions in Saudi Arabia. We're clearly conduit for airlines to finance themselves in the country. We're not the only one, very clearly, but we expect to do a lot of transactions there. So we want to create sidecar vehicles around us to attract private capital, whether local, regional, or international, to underwrite some of those transactions. Right? And so that's what we're working on today. We think that A, it's a very attractive business, obviously. And then B, I think part of our role is to explain the industry to new private investors and bringing new capital into the business locally and regionally. And I think I'm starting to get some traction there. Right? So that's the sort of on the asset and the equity side. And on the liability side, as I explained earlier, we have clearly a target to get rated. Right? Maybe 2025, we'll see. but it feels that it's the right way for us to expand on our strategy, secure our financing, attract further international capital into the kingdom, and deliver better returns to our shareholders, basically. So yeah, it feels great, to be frank.
And a lot in that, and a lot I'm going to start to pick at now in a moment, but really well done, I think, on where you've come so far. Personally, it's been a pleasure working with you guys over the last couple of years.
Same here.
If we maybe start on the demand environment, right? So if we look at the strong bounce back in travel, it seems to have followed through. As you look at customer performance on the airline side over 24, how have you found that, and how has that fed in across maybe lease rates and extension rates for you guys?
Yeah, so let's break this down sort of, let's start with the demand side. So, I mean, demand is obviously robust. I'm not going to tell you something new. I think August RPKs grew 8.6% globally. So clearly, we're still in a very strong demand environment. Obviously, ASK has not tracked that for obvious supply reasons. But that picture is somewhat different around the world. So if you start by the US, or Americas rather, which represent about 24% of the market, but is a leading indicator of what's happening in the market. That growth has abated, right? So that growth is in the 4% range, 4.8% exactly. What we've seen there is a great level of capacity that has been delivered over the previous year and a half. Some of the aircraft that we're going to deliver to China and other regions of the world actually were redirected to the US. And there was influx of capacity, which created a lot of pressure on yields. And you've seen earlier in the year, the yields completely collapsed. Right? Thankfully, obviously, the US carriers are very disciplined, very organized, and reined in capacity very quickly. And so you've seen a rebound in yields very quickly. But I think it's a sign of things to come, right? So normalization plateau of the demand. I don't think we can expect another 8 to 9% growth year next year. Now the bright spot is Asia, right? So clearly here we've seen last month I think it's a 13% growth rate in RPK. So bright spot or very positive is India, right? Inside India and out of India, a lot of traffic coming out of India is very strong and somewhat replacing some of the Chinese traffic, which is still lagging, right? And so that's very interesting. The Indian revolution or extraordinary development of the economy is happening in the most populous country in the world. We're seeing this happening here. When you speak to all the regional carriers here, they're seeing a great level of influx from Indian travelers, tourists going to visit Thailand, et cetera, right? So a very interesting phenomenon. China is very strong intra-China, yet to have the sort of impact on international traffic that we expected. I think we do expect that to come back over time, but still not quite at the level where we would like it to be. Lagger is Europe, right? Obviously, European economic environment is not strong. It's got a number of economic and political issues, and I think traffic growth has been robust in Europe, but in not quite the bright spot that we would hope it to be, right? So it's not as big of a market for us yet. We would like to do more business in Europe, but we're not sensing the level of bounce back and future growth that we would expect. Obviously, Middle East has been a very bright spot, a lot of capacity going into the Middle East. But load factors have held up very well. There's a lot of capacity coming there. I think that's a region that's going to be dragging a lot of traffic from different areas, whether it's Turkey, Saudi Arabia, the Middle East in general. It's going to be a very interesting region to watch, and we're frankly very well positioned to play there, right? So overall demand, I would say, has been very robust. clearly passed over the pre-COVID environment. Yields have been strong, but we're plateauing. Right? We expect the growth to come back to a more GDP tracker style, sort of 1.5 times GDP growth, 5% growth in the economy. I think the bright spot for us is Saudi Arabia, right? So the GDP growth is expected to track to 3 to 4% overall, with non-oil GDP to be in the 5% range, right? And so that is impacting the economy in several ways. First of all, if you try to fly into Riyadh, it is amazing, right? There's never a single open spot in every single aircraft I've taken. And I fly a lot in and out of Riyadh. It's amazing. And so there's a lot of capacity required to fulfill the demand on the business traffic. Tourism is developing, which it's a really big push as part of Vision 2030. And then as a result of the non-oil development of the economy, freight is developing. And so the target there is actually to quadruple the capacity in freight. And we're very involved also in that discussion. So obviously, focusing on the kingdom, we see a lot of opportunities. And if you look at all the aircraft deliveries multiplied by the average purchase price that we think airlines will be paying, that's about a $35 billion opportunity between now and 2030. Right? So big demand there, and that's going to continue.
Yeah, there's a couple of sounds. You look at the Riyadh Air order, or if you say you move it back on the Indian side, the investment they have in infrastructure and airports, and again, you go back to orders we've seen from Indigo, we've seen from Air India. Be interested to see around the Saudi carriers, do they follow more of that Indian model of predominantly leased aircraft, which obviously for the likes of yourselves could be a really interesting piece. If you look at that customer base that you currently have, Ted, and if I bring you into maybe lease rates and extension pieces, so what we're kind of seeing to the conversations we're having here is one, your extension conversations are happening a long way out, and they're generally lessor friendly given the demand, supply and balance. Maybe we'll come to supply in a second, but just those elements around lease rates and extensions, what are you seeing?
Yeah, I mean, very clearly, when we started, we were expecting, like any other lessor, to have a sort of 50-50 at the end of the lease, 50% extension, 50% releases. Right now, we're in a 90% extension. And I think that's across all the leasing companies. That's very clearly the case. We, in our business case, I mean, I can tell you we're about 15% above the lease rates I was projecting in the business case. If you look at sort of the 320s, we don't yet have an order book, but if you look at the lease rates are in the 320neo, in 321neo range, or 73 Max, I think everything starts with a solid 4 right now, right? I think it feels good. Obviously, interest rates have risen up quite a bit, but in spite of that, there is clearly a strictly incremental yield on the assets. I think that will stabilize around that because if you look at the supply side, just putting aside the non-delivery issues, which we can discuss, but the actual amount of deliveries going into the market are really focused more and more on fewer and fewer carriers, right? And so I think that's a big trend that the market is not realizing, is that the OEMs, Airbus and Boeing, have really focused their sales to fewer and fewer airlines. I think the number, maybe not exactly right, but it's the top 25 airlines represent 70% of the backlog, right? So what is the consequence of that? The consequence is that everyone else is looking for lift, right? The smaller, mid, second, third tier airlines have to go through the leasing channel, right? It will probably end up in pushing further consolidation of the industry. I'm not sure that's good or bad for the business, to be honest. I think that's something the OEMs should think about. But very clearly, if you have a backlog today, you feel pretty good. And so I think that's clearly the case now, especially with the supply constraints. That will continue in the future, and we therefore want to have a position with the OEMs. I guess I'm not positioning myself very well for a discussion with them, but I think it's part of the playbook that AviLease is gonna unfold, right? And we will be a big balance sheet lessor. We will have an order book because that's part of the strategy, and that's part of the value we deliver to our airline customers, right? So coming back on the lease rates, very, very bounce back, very solid. Part of that is interest rate. Part of that is sort of lack of supply. And I think that's going to continue for a long way. If you look at the share of sales to lessors, it's actually have reduced over time, right? So we think this is an opportunity for us to play in, right? Sorry, you want to ask?
No, I was going to bring you, because I'd say that's where you were going to go next, was around that supply side piece. As you said, the ambitions you have to grow significantly are going to be very much linked to the output on the OEM side.
Yeah.
And that's either you building your order book or sale and lease back or secondary market. How concerned would you be as to where the OEMs currently sit? We obviously had positive news on the Boeing strike yesterday, but that's just a cog in a very challenged wheel. Your thoughts on how challenging that the OEM current position might be for your growth strategy, and just how you see that uncorking?
Yeah. So all right. So just putting round numbers to the table. So roughly 1,200 aircraft deliveries last year, probably a little bit less this year. 600 units on the 320 family side. About 380 units delivered on the MAX side, bulk of deliveries, of course. Obviously, Boeing, up until the strike, they had delivered roughly a quarter less of the deliveries that they did the previous year. So and that is deliveries. I'm not talking production, right? So there's that delivery cap, but actually, if you look at what is delivered, a portion of that is destoring aircraft from the MAX grounding, and a portion of that is actual production. So the actual ramp up of the MAX side, starting with the Boeing side, is really coming from the teens, starting back from the teens, and needs to go back to that rate 60 some that they're targeting. That's a long way. That's a long way to get back into. So we expect this will take them years to get to the sort of levels that they expect to deliver. On the Airbus side, I think they're indirectly suffering from the Boeing issues, and while I think they will deliver that 600-ish aircraft this year, and I think they're on track to do that on the 320 family. They are suffering from sort of the same supplier base being hurt by Boeing's delays, right? And so I think Airbus is scrambling to make sure that their sort of tier 2, tier 3 suppliers are there to actually deliver, financially are in decent shape, and can withstand the ramp up they expect to go to. So rate 75 requires a lot of CapEx investment from all the supply side. And if you talk to the engine OEMs, to the smaller suppliers, a lot of them are frankly scratching their head and say, well, there's a lot of investment. How long are they going to be able to sustain that rate 75? And how much risk am I taking in my own financial business case? So I think that's an interesting place to watch. Still feels pretty fragile. You talk to every airline, everybody's disappointed by the short-term delay. I think they're more disappointed by the lack of visibility than the delay. I think people can anticipate a delay, but the lack of visibility, even a few weeks ahead of a delivery, is really hurting a lot of people. So I think that's the OEM, and the OEM should really think about that a little bit more.
Communication as much as anything.
Communication, anticipation, making sure they give more transparency. And not necessarily hide behind non-excusable delay clauses, which, or excusable delay clauses more accurately. But it's part of the playbook. It's a duopoly. We need to have relationship with both Airbus and Boeing, maybe even Embraer. We'll see if we can develop that relationship. And it feels that it'll take years to get to the sort of delivery stream that is started by the OEMs. There's sort of 7,000 aircraft on backlog on the Airbus side and almost 4,000, 3,800 on the Airbus side. You know, we're talking about aircraft deliveries into the next decade now, right? So the good thing from a lessor standpoint is that the technology feels pretty stable, right? We don't see any sort of major changes on the lineup, both on the wide body side, certainly on the wide body side, and it doesn't feel like neither Airbus and Boeing are ready to pull the trigger on a new narrow body technology anytime soon, right? So we have a really long runway in front of us from a technology standpoint, which feels good, right? Feels like we can therefore make decisions over a longer period of time for our side. And then that supply side may be actually, that constraint may actually be a blessing in disguise for a lot of airlines, right? That have been able to push up yields, reconstitute their balance sheets over the last couple of years. So I think it may not be all bad for the industry, frankly.
Yeah, and maybe feeding that into what you're seeing in the trading environment. Obviously, as AviLease has had that rapid growth that you've articulated, it's been around kind of inorganic M&A, it's been around strategic sale and leaseback, and it's also been in portfolio acquisitions. Can I get your perceptions on the health of the trading market? And I'm not sure if you guys have started to divest yet on any aircraft, you're still just full in acquisition phase, but how healthy do you think that trading market is given that kind of supply constraint overhang?
So yes, we have started to trade. You know, that's where I come from. I'm naturally an aircraft trader. And I think that's a healthy part of your strategy. You need to churn your book. It demonstrates that when you sell aircraft, it demonstrates that your book is in the money, and then you can generate value like this, right? And I think it's part of the cash flow generation, profit generation, risk mitigation strategy of the company. So very clearly we are and we will be very active sellers of the portfolio. That's one of the things I am very, very convinced on, and we've built a team around that who's already transacted one aircraft. We expect to close more aircraft transactions before year end and into next year. And that's going to be a very active portfolio management that you'll see us developing. The market we've been more net much more buyers than sellers. Earlier in the year, we felt pretty good frankly, we were almost the only ones buying in bulk, and that felt great. And I think it seems to be that we're still one of the few ones that can move in bulk. Very large transactions don't frighten us, and that's a way for us to differentiate ourselves, and we can do very big deals. The ABS market is now reopened, so it feels like that market is going to be a little bit more active on the buy side also. So we'll have a bit more competition coming when it comes to bidding on portfolios, etc. Obviously, the ABS market is a key financing market for secondary trades, right? So that market being reopened is a great news for the industry in general.
I'll ask you while I have you on that piece.
Sure.
Do you think that would be a market AviLease would ever have an interest in, given probably your access to funds that we might come back to in a second? Probably not, or is it something maybe on a divestment asset management strategy if we ended up back in a Nino world?
Yeah, so I think, look, my strategy is keep it simple. I don't really want to have to look at ABS today or anytime soon, for the simple reason that we are doing a lot of things. We have a very simple playbook we want to deploy, and we want to stay very focused on deploying that playbook. So that playbook entails unsecured financing, today on the private basis, tomorrow on the public basis, through bonds. That's what we're going to focus on, right? The ABS market for us is a great outlay for buyers to buy from us to finance themselves. I don't see us issuing to the ABS market for the next 24 months, frankly, right? That market is great, but the problem is that it opens and closes, right, very, very quickly, number one, so it's a bit hit or miss. And number two, it's more expensive for your own balance sheet, so it's really purely a sell tool. Excuse me. And on number three, it's more complex to manage. So if you have a series of ABSs to manage, you have concentration limits to manage, you have a lot more administration around those portfolios, and those are sort of basically separate balance sheet from your own main balance sheet. So it creates complexity at the organizational level, which frankly I'm not interested in at this point.
Yeah, and that'd be entirely logical. And maybe bringing you back to the traditional aviation debt market, you guys obviously raised a lot of funds, both as part of Standard Charter on a bridging basis, and then what you've done and kind of refine that, and more generally, do you want to talk to us about your assessment on the health of the aviation market? You mentioned as well, you're funding a lot out of KSA. Is that Middle Eastern region, or is that highly geographically spread?
Global. So as I said, we have 3/4 of our funding coming from non-KSA lenders. We have seen a lot of. So we did a $2.5 billion unsecured financing, both Sharia compliant and non-Sharia compliant. But sort of Sharia was about a third of the book, and non-Sharia was 2/3. That's one of our competitive advantages, right? And differentiation is that we can access sources of funding regionally, which few other leasing companies can, right? And those sources of financing are pretty attractive, right? So our strategy is not to rely on them, and therefore to open relationships globally, here in Asia, but also in Europe and in the US, and we've done so already. We want to get to our lenders to roughly 80 banks to 100 banks. I want to make sure that we have relationship globally, because we're a global business, right? So, having said that, the degree of positive reception we've received in the domestic market has been extraordinary, and as a result, we've been able to print several transactions, RCF, unsecured deals, at levels which, frankly, are very competitive with the top of the leasing industry, right? And we're using the local source of funding to pressure the international lenders to align themselves with that. We've done this very smartly. Our treasury team has done that very, very, very effectively. Once we're rated, I think we'll be even more effective in that, and they expect our cost of capital to be in line with the best in the business, to be honest, right? And so that's a key competitive advantage from here. If you think about, our input cost is cost of aircraft, cost of capital, right? So right now, we're a market buyer on the cost of aircraft, right? If we go speculative, we will hopefully buy in the money, and as we grow in terms of size, bargaining power increases your cost of aircraft. Cost of funding, I think we're going to get there very quickly. I think in the next 18 months, we'll start borrowing, at the top 5 of the business, right?
And maybe to pick at that a little bit around the investment grade status on that journey to investment grade, what are the key building blocks? You kind of say scale now, you're probably not far off where we see some lessors that are there. Is it just a little bit more proof of concept and time in the game, or what do you see as the key building block to get that rating?
Well, remember we purchased Standard Chartered's aviation team and portfolio. Part of the rationale for that transaction was the track records, the banking processes, experience in managing through the crisis, the systems, etc. So that was a big portion of the rationale for that transaction, and that's why we leaned into that deal to get it done, right? So that allows us, we think, to accelerate the rating by probably 24 months as compared to an organic route, right? And so we deliver, we think, a fully matured platform, as I explained earlier, from a people, process, system standpoint to very early on in our journey, right? And so I think we're going to get rated, frankly, fastest than anybody has done in our industry. maybe short of Steve at AviLease and his team. But we really want to get it done quickly because that's value and that's risk, right? And we think we have a decent chance to be IG rated on a standalone basis, to be honest, right?
And maybe just to pick up on that Standard Chartered piece, if we look at the M&A that's happened across the leasing space over the last 2 years, it's kind of been in that 150 aircraft bucket. If you think Standard Charter, AMCK, Goshawk, Fly, more of a portfolio acquisition, but those bits that were there and some of which you would have been involved in your former guises. Do you think we'll see more M&A in the market, or is that opportunity out there, or have those kind of subscale providers mostly been swallowed?
I think this is a natural portion of our business, right? And it's really, as people are, as I explained, the airlines are concentrating, right? Through OEM sales, through their own natural scale-up requirements. So our customer base is concentrating. And so what constitutes a scale for a leasing company has evolved from, when I started, a 100 aircraft portfolio was a pretty decent sized portfolio. Now, if you're less than 400 to 500 aircraft portfolio, I think you're probably not at scale, right? And so, because your customer are concentrating, the industry is naturally growing in size. The industry is growing itself, right? So the fleets are growing, the share of leasing in the fleet, aircraft fleet is growing, and I think the business will be concentrating, right? And so there'll be deals, right? And I think the question is, for anyone past the top 10, what do they want to do, right? And what is their shareholder commitment to do? And so I think there'll be some decision made by those boards over the coming years to grow or exit that will constitute opportunities. In the top 10, I think same discussion, probably a bit more complex. Those are bigger deals, and you really need to have much more firepower to underwrite transactions like that. And it feels that you'll need to have entrance into the industry to be able to underwrite transactions like that, to be honest.
Yeah, it does seem to that piece, right? You're going to end up with a number of very large players, and is that 5, is that 10, is that a dozen, and then a bunch of, to a degree, niche or USP players that have that access, whether it's JOL market or a certain playing cleverly in the secondary market. Had some really great stuff and all of that. In closing, right, as we sit here in November in 24, looking out into next year, what are your optimism levels like?
I think we're in a very strong industry. Right? It feels like, if you think about the 3 major risks this business underwrites, it's credit, airline credits, it's assets, and it's financing risk. And those 3 metrics, the industry feels very stable, very robust, right? I think there are some geopolitical tensions there, but they actually have not translated into spike interest rates or issues on the demand side at all, right? So the market has been able to absorb this, realign itself. So, to be honest, it feels pretty good, right? We're protected by a duopoly, which is constrained right now from a supply chain standpoint. So supply side is very constrained, demand is robust, technology risk is not really there, or not in the short term at least. Interest rate feels relatively stable. We know where the long end of the curve is going to land. We think, that 3.5% to 4.5% zip code is probably the right zip code to think about long-term interest rates. So it feels the right industry to be in, right, and to invest in. I think I'm very hopeful, and to be frank, with the sort of shareholder that we have today, I'm leaning in.
On that very positive note, I'd like to thank you as always for your time and insights, and wish you and AviLease, on behalf of KPMG and Airline Economics, a very successful 2025.
My pleasure, Joe, and thank you for all your support through those years. Thank you.
Cheers.
Thank you. Cheers.